All right, well, it is a double dose of disappointment for markets. ECB President Mario Draghi failing to provide a clear fix to Europe's woes just one day after the Fed here in the U.S. stopped short of another round of stimulus. Here to explain the market's reaction to all of it is Frank Fantozzi, CEO of Planned Financial Services in Cleveland. Frank, thank you. I'm rushing here. We have so much news going on. First, let me get your take on the Knight debacle and its influence on the market today. Is it partly to blame for the sell-off?
Clearly, that had something to do with the sell-off, but I also think consumer sentiment, as well as the lack of action by the Fed, has contributed to the sell-off.
Yeah, it's just a pile-on of bad news. So where are you advising your clients to invest their money?
Well, throughout the year, we've been telling, Lori, our clients to take more of a defensive measure. We've also cushioned this by sharing with everyone that as we get closer to the election, to anticipate a lot more volatility in the marketplace. Having said that, there's probably like 3 areas that we're asking clients to consider overweighting. One is in industrials and technology. We feel that that is going to be a strong area going into the election versus, healthcare as one and defense as another. Mid caps do well coming out of a soft recovery, which is where we're at right now. And I would say high yield bonds and municipals are other areas that consider overweighting, given the tax changes that are going to loom on the horizon.
So, Frank, your whole thesis is based on the election as well as the tax climate for the new year. When we get past the fiscal cliff, which I know you could probably work into that theory as well, right, are you going to readjust your whole strategy?
Well, I think once the election's clear, we're going to have a clearer landscape in which to plan. I think uncertainty is not what the market likes, and it makes it very difficult for advisors to plan and advise clients when you have a lot of moving parts. We have increase in taxes coming down the pike. We have spending that's going to be cut back by the government. So you have these 2 areas that are going to hit the GDP, and potentially, if you take the whole fiscal cliff and say that was all implemented, there's a potential of a 3 to 3.5% drag on the GDP, which would be very disastrous for the economy. I think once you get through the election and the compromises take place, we're looking at probably a 1% hit to the GDP, which I think the markets will handle.
All right, Frank, come back very soon. We're a little short on time due to the breaking news this hour. Thanks a lot.